Is there a way to virtually guarantee that you make money in the stock market? Well, the good news is yes, and that is what this video is all about. When it comes to investing in the stock market, you basically have three main options. You can use a professional financial advisor, you could try to pick the winning stocks and funds yourself, or you could just use a simple index fund. The first two options are known as active investing because you or your advisor are trying to beat the index fund, also known as the market. And the third option of just buying an index fund is known as passive investing. And this is where you are happy to bank the market returns. For the S&P 500 since inception has been around 10%. Now, for the past 100 years, the stock market has been dominated by active investing, and one of the most famous active investors has been Warren Buffett. However, since the birth of passive investing and the index fund in the 1970s, passive investing has been growing in popularity every single year. Well, just a few years ago, this happened. We had the flippening. So I'm going to take you back to the turn of the century. This is data from 1998. And it's the percentage of assets in the US equity funds by investment type. So you can see it's dominated here by the active funds. Over 20 years ago, the leading was the active large cap fund, then active large blend, then active large value funds, and then the active others. For passive investing, the best one was the passive large blend, and then the other ones, as you can see, were pretty non-existent. Now, fast forward to today, this is data from 2019, and the vast majority of money is in the passive large blend. Next are the active funds, and you can see a big reduction, and then the other passive funds are really beginning to make headway. But we have now had the flippening. There is now more money in passive funds than there is in active. So you might have already heard of the fact that most people don't beat the market. But is this actually true? And if it is, then why do so many people still pick individual stocks and they build portfolios on their phone? Well, I'm a person that likes to work with facts, data, and evidence. And as there are hundreds of videos out there, all with hundreds of different opinions, I also wanted to give you guys a place where you could get access to the data and the facts. And that is what this video is all about. And I wanted to show you guys how you can virtually guarantee that you win when it comes to stock market investing. So here is the truth. You have the industry with all the funds, all the brokers, all the middlemen, and you have the investor. And here is what the industry and the brokers and the apps are all trying to get you to do. Check this out.
Name of the game, move the money from your client's pocket into your pocket. Right. Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right?
I don't care if you're Warren Buffett or Jimmy Buffett. No one knows if the stock is going up, down, or in circles. Because every time a stock is bought or sold, there is a middleman taking a little slice. So what is an investor to do? Well, I know it sounds plain, I know it sounds boring, I know it sounds just too easy, but it's to just keep investing into an index fund. That is how the small investor wins the game. And here's the proof. So for the proof, we have the data every year from Spiva. And this is the S&P indices versus active. Every year, Spiva crunches the data and compares these active funds with the passive. And here is a full breakdown of all the different categories: small cap, medium cap, large cap, multi-cap. So what I'll draw your attention to is this one. And this is because this is a blend of multi-cap. So this will include all the small, medium, and large. And you'll notice over the short term, so this is just a 1-year period, that it's pretty close to 50-50 whether professional fund managers can beat the index. As we extend the time period to the 3-year, we can see that 63% of professionals don't beat the index. When we go to a 5-year, 72% of professionals don't beat the index. 10-year, 86% of professionals don't beat the index. After a 20-year period, period, this is now 90% of professionals do not beat the index. And obviously, if we keep going 25-year, 30-year, it's only going to get worse. And when it came to the individual investor, there was no real hard studies, but every single website I could find pretty much says the same thing, that they do even worse than the professionals. And pretty much smaller individual investors do not beat the market over the long term. And this is a great piece of data here. This was data of the S&P 500 between 1926 and 2015. And it showed that if you invested in the S&P 500 any of these days, it would be 50-50 whether you made money. If you invested and waited a year, you went up to 74% chance of making money. After a 5-year period, an 86% chance of making money. And then this is what you need to know. In the long term, over 10 years, and certainly over 20 years, in this time period, it was guaranteed that you would make money in the stock market. So as you can see, the data really doesn't look good when it comes to trying to pick individual stocks or funds. Over a 20-year period, 90% of professionals won't beat the market, and it's even worse for the smaller investor. It's closer to 99% of people that over the long term won't beat the market. So the question that came to my mind was why? Why is it so hard to beat an index fund that only does about 10% a year? Well, I'm glad you asked. Let's find out. Let me introduce you to the efficient market hypothesis, and this is a logical progression, and it goes: all of the stock prices right now reflect everything we know about the stock. The future price then is based off new information. Nobody knows or can predict the future. So knowing where the stock price is going or trying to time the market is virtually impossible. This is Professor William Sharpe. He is a Nobel Prize winner, and he worked out that you would need to be right 74% of the time to be able to beat the market. And the reality is that you're only going to be right about 50% of the time. This is why over time you will likely lose money. And here is the reason why. This is Global Capitalism Inc., the global market crunching all the businesses in the world. This is the data from a few years ago in 2017, but the total market value was $51 trillion. That made up $30 trillion in sales. This is in over 400 different industries in over 195 countries all around the world. And this is what makes up the market. And the human brain does not have a chance of crunching all of this data and then figuring out where the market is going. And then we have all our cognitive human biases: herding, regret, media response, optimism, anchoring, diversification, mental accounting, narrow framing, loss aversion. We see things that are going up and we chase it and buy at the wrong time. We get bored and irritable when stocks go down and we cut the losses. We log into our accounts and we check our numbers day after day, and we're tinkering and tweaking when the best thing we can do is just leave our portfolio alone. This means we're building up the fees, we're building up the tax implications, and the best thing we can do is just leave our portfolio alone. And this is Benjamin Graham, and he was the mentor of Warren Buffett. And he said, the investor's chief problem and even his worst enemy is likely to be himself. So to effectively time the market, we need to be right about 74% of the time. But the problem is, for most people, we're right about 50% of the time. You're going to get it right about half the time. And this is why people say that monkeys throwing darts at a list of companies are just as likely to beat the professionals. So the stock market is made up of millions of people all doing millions of transactions, and the human brain is just not capable of crunching that much data. And then we have all our emotions and cognitive biases that get in the way. And as Benjamin Graham said, the number one biggest risk to your investing success is you. Okay, so let's finish up by getting the opinion of the expert investors. Check it out. And here is what the experts have to say on the stock market. We have Ray Dalio. Timing the market is basically playing poker with the best players in the world who play around the clock with nearly unlimited resources. You don't want to be in that game. Or how about Jack Bogle? Don't look for the needle in the haystack, just buy the haystack. Or we have Warren Buffett. My regular recommendation to investors has always been a low-cost S&P 500 index fund. And even in the most recent Berkshire Hathaway shareholder meeting of 2021, the main point that Warren Buffett pointed out was this. He showed that in 1989, this was the top 20 companies in the world at the time, mostly dominated by Japan. Fast forward to today, and it's a completely different list of the top 20. Not one Japanese company, and the entire top 20 had changed, indicating that you probably won't know which stocks are going to be the winner. And then we had Warren Buffett's bet. In 1996, he put out a challenge to the hedge fund industry, and he said, "I bet none of you can be a simple S&P 500 index fund." He bet $1 million that no professional fund manager was able to do it. After a while, a company took him up, and there was multiple funds trying to beat the index over the next 10 years. And this was the result. Over the 10-year period, Fund A did about 20%, Fund B managed 40%, Fund C managed 88%, Fund D only 3%, Fund E about 27%, and the S&P 500 crushed all the professional fund managers at 125%. So you have seen the data, you have seen the evidence, you have heard from the experts, and even the market has spoken. There is now more money in passive funds than there is in active funds for the first time in history. It's official, passive investing has won. And to virtually guarantee that you make money in the stock market, all you have to do is this. Keep investing in a simple S&P 500 index fund and hold it for over 20 years. This way, you will be 90% of the professionals and about 99% of all the smaller investors. So there you are, guys. Hope you found this useful. If you did enjoy anything in the video, be sure to drop a like, and a big thank you to everyone who does. If you haven't yet subscribed to the channel, I invite you to click below and join us. I do have some great videos coming up that you don't want to miss. Okay, cheers guys, thanks for watching, and I'll see you in the next video. Bye for now.